It is a great pleasure to welcome to Best Ideas 2025 returning MOI Global Instructor Mordechai Yavne, the founder and manager of New York-based Focus Capital Management, a boutique long-only hedge fund launched in 2013. Focus Capital Management is a fund with a fairly unique approach to investing. The unique advantage comes from implementing and capitalizing on the value that concentration brings to an investor's portfolio. Mordechai believes that focusing his energy and time, research, analysis, and resources on his best ideas generates superior long-term returns with a reduced level of risk built into each investment. He aims to invest in 4 to 5 positions at a time and believes this concentration and the deep research he invests in each of the positions is the driver behind Focus Capital Management's long-term success. And more information can be found at focuscapitaladvisors.com. Mordechai, great to have you with us again. I really look forward to your presentation and would now like to turn it to you. Please go ahead.
Thank you, John. Thank you for the introduction. It's a pleasure to be back here at Best Ideas 2025. This is the 4th time I'm presenting at Best Ideas. And really, as John explained, Focus Capital Management is all about best ideas. By investing in only 4 to 5 positions at any one time, we're not looking just for a good idea. We're looking for a great, out of the ballpark idea that can really move the portfolio with higher returns, lower risk, by concentrating on situations where the risk reward is so out of whack as to be really rare to find. We scour the world to find these ideas, and we think we have an idea like that to share with you today. And I hope you'll agree after hearing what we have to say. So let's get straight into it. I'm presenting today on Valeura Energy. It's a Canadian stock. It's an oil company that's centered. Its assets are centered in the Gulf of Thailand, and I believe that we can say it's really the cheapest and best oil company on the planet. We can literally say that. And let's tell you a little more about it. First, we give an overview, goes through some of the history, acquisitions they've done, and where to take it from there. So, as I said, Valeura is the cheapest oil company on the planet. It's the largest independent oil company in the Gulf of Thailand. The only larger company is the state-owned oil company of Thailand. Otherwise, they're the largest player there. As of the end of 2024, they had $259 million in cash, US dollars. Everything is US dollars. It's a Canadian company. Other than the share price, all the numbers we're going to share are US dollars, as the global oil industry deals with dollars. So they have $259 million in cash, no debt, making about $150 million a year in free cash flow. And the market cap is just $610 million. So that's just amazing what you're getting for that, for basically an enterprise value of about $360 million. You're getting a free cash flow of $100 to $150 million or so. So you're dealing with enterprise value to free cash flow ratio of about 3. I've been pounding the table on this for a number of months. Back when I was first pushing this in September to people I know, I was hyping this as a company with about $150 million in cash, making about $100, $150 million a year at a price of $350 to $400 million. Well, that deal is not quite on the table anymore. It's not a $400 million market cap anymore. It's a $610 million market cap, but it's still drastically undervalued for what you're getting for that money. A few months ago, we were dealing with $150 million cash. Now we're dealing with $260 million in cash. All this really comes down to the stellar capital allocation of the company management, which we're going to get to. It's really the story here, is their success in acquisitions and in putting the company's money to use to really grow the company in a highly profitable manner. So let's start with the prehistory. Usually, it's not so important to discuss where the company came from, what it originally was, but in this particular case, it's all about how the management took what was really a small sum of cash and really just wheeled and dealed it until they got to the present company is today. Originally, Valeura had some Turkish gas assets. There were production assets and some assets that were under development. But they felt themselves in somewhat of a dead end for growth. Their assets, they didn't see that they were going to be growing there in Turkey. The amount of money needed to develop some of the development assets they had was not worth it at the time, especially with the low price of gas then. So in 2020, Valeura sold their remaining production assets and they left themselves basically with one development asset, which was not being developed, and in the safe, $40 million of cash on the hunt looking to acquire. Many companies, many management teams, when they have money and they're looking to acquire, it's burning a hole in their pocket, and they're often not making the best of acquisitions. They're looking to increase their fiefdom. I'll be the first to say that I do not like when companies are busy acquiring. It's usually not a good sign. I think studies have shown also that most acquisitions are made are value destructive. The buyer overpays for the acquisition, and it's just really the manager looking to manage a bigger company. Valeura's management was not that way. Really, kudos to the CEO, Sean Guest. He's been with Valeura for years. He's the architect behind all this. Those $40 million of cash looking to acquire, they patiently bided their time more than 2 years until in 2022, they were waiting for the fat pitch. They got 2 fat pitches, and they made 2 transformational acquisitions for incredible value, taking the $40 million of cash and turning into what is now a $600 million market cap and still undervalued with plenty of growth to come. These 2 acquisitions, instantly transformed them from a company with cash and one non-developed asset in Turkey into a major player in the Gulf of Thailand, largest independent oil producer in Thailand. And they still own that deep, tight gas appraisal play in Turkey. They're not investing money in it. They're looking for partners. It's still a possible source of future value, but right now, the story is all about Thailand. So what were these acquisitions? So we have 2 acquisitions. Great acquisition, acquisition number 1, and greatest acquisition of all time, acquisition number 2. What do we have here? So the first acquisition is actually the second acquisition in terms of their negotiations, but it's the first one that they announced and the first one they closed on. In April 2022, they announced this acquisition. It closed in June. Basically, they purchased an oil field that was shut in, not due to any problem with production with the oil field, but due to bankruptcy. Chris Energy had too much debt. The oil prices were low at the time, and they went and forced them into bankruptcy. And then they let go some of the least oil tankers that were used to service the field. So although the field was perfectly fine and in maintained condition, there were people working on the platform all the time to keep it up in maintenance, but Chris Energy couldn't bring it back online even when the oil price recovered a bit. So they bought this asset out of bankruptcy. They paid $3 million for the oil field, about $9 million for the MOPU, the mobile operating production platform that was associated with it. So all in all, they paid $12 million for this oil field, plus contingent payments, $2 million contingent on their first infill drilling to expand the present assets, and then another $5 million for a second oil field that they were getting along with it, the Rosticon oil field. If first oil ever came from the Rosticon oil field, that was not ever a producing oil field, that was a development asset. If they were developing at first oil, they would have to pay another $5 million contingent payment for that. But just for the Wasana oil field as they got it, was ready to restart at about 3,000 barrels a day, potential to rise to 5,000 barrels a day. And for that, they were paying, between the field and the equipment, $12.3 million. Bottom line, the cash flow they were seeing from this field, just from the Wasana, ignoring the Rosicon, just the Wasana field was at the then Brent price of about $100, was going to be cash flow of $36 million a year after the royalties to Thailand, after OPEX, after income taxes. They were going to get $36 million cash flow from this oil field, for which they were paying 12.3 million plus that 2 million contingent for infill drilling. So let's call it 14.3 million. And they were going to get $36 million for paying 14.3 million. That is a fantastic deal. Brent then was about $100. Even at lower oil price of $70, so they're not making 36 million annually, they're still making a net cash flow of 12 million annually, which was very good. And eventually they never developed the Raskin oil field. They actually sold it to somebody else to develop. And they're getting from that an ongoing royalty of 4.65% on their 43% interest. That comes out at the Rasican's 10,000 barrels a day production rate. It comes out to about $5 million a year. So again, for 14 million, they got an asset that at oil price of 70, which is lower than the oil price today, is a net cash flow of 12 million annually, plus 5 million from the royalty from Rosicon. I would point out when we're talking here, the net cash flow is before capex. Any capex needed to maintain the field is going to come from this 12 million. It's still very, very, very good deal. And as we'll see later, this deal was actually even better than it looks, because it came with huge tax losses to be carried forward, which really ended up becoming very beneficial when it was combined with the next acquisition, which we'll talk about in a moment. So this was the story. This was why they wanted to acquire. They were getting a great deal. How did it work out? It worked out great. They purchased first, originally they only had 89% operating interest. There was a partner that had 11%. That wasn't selling. Later, that was increased to 100% interest in April 2023 when the partner bowed out. There were some hiccups with the restart schedule. It didn't start quite as quickly as they had hoped for. Ended up restarting in April. Shortly after it restarted, the operator of the third-party operator of the leased FSO, that's the floating storage and offload vessel. That's the vessel that holds oil that the field is producing until it gets picked up by tankers and sold to others. It's temporarily being held on the field in this floating storage vessel. So the third-party operator managed to bump into something, and they had to suspend it for a little bit to make repairs. And they actually replaced the third-party operator. I think this was the second time the third-party operator had made an accident that caused issues with the production. So they replaced the operator with a better one. But in the end of the day, it took a little longer than originally predicted, but they did restart in December 2023. It's been producing as predicted, 3,000 barrels a day. Later, it rose as predicted to the present rate of about 5,000 barrels a day. As is bolded on the bottom of the slide here, you see that they had quite successful infill drilling and appraisal wells. So infill drilling is where you drill, you have your wells, and you move over a little bit to the left, a little bit to the right, you drill some more wells, and you get access to more of the oil in the reservoir. Appraisal wells is when you're drilling more wells to see how far the oil field extends and to increase the level of your reserves. They were able to show a massive increase in 2P reserves. That's 2P means proven and probable reserves, which are the reserves you could expect to basically take to the bank, that you should be able to get those out of your oil field based on the present price of oil and present expectations of how much it will cost to reach that oil, that these oil is economical to be producing with. In fact, the appraisal wells were very successful, and further appraisal near Wasana in Wasana North, there's now a strong possibility of adding a new platform to Wasana North, getting 20 million barrels reserves at a capex cost of 150 to 200 million. They are right now in the middle of the necessary engineering and studying of what they need to do there to make that happen and whether it makes sense to do it. And they expect to make a final investment decision within a few months on sinking that CapEx in to massively to reach that about $1.4 billion worth of oil gross. So Wassana has turned out to be an extremely good acquisition for them. For just 14 million, they're getting this cash flow of 12 million a year, 5 million royalty they're getting from Rasukan. Then there's CapEx, and there's ability to grow much more with the Wassana North development if they choose to go ahead with that. What about the second acquisition? So the second acquisition is literally, you have to see it to believe it. Absolutely incredible, greatest acquisition of all time. Basically, Mubadala Energy, which is owned by one of the sovereign wealth funds of Abu Dhabi, the United Arab Emirates. Mubadala Energy wanted to divest itself of its Gulf of Thailand oil assets, and they sold this to Valeura, which instantly catapulted Valeura to being the largest independent oil producer in Thailand. They're not just getting the assets, they got the entire business unit, all employees, all the people who have been with this field from the very beginning and know exactly how these fields and know how it's operated. 3 fields: Jasmine oil field, in which they are acquiring 100% interest in, Nangyao, which are getting a 90% interest in, and a Menorah oil field, which they got a 70% interest in. These were 21,000 barrels a day, netting about $15 million a month after you take out royalties, OPEX, and tax. Pretty low OPEX, actually, of only about $22 a barrel. Nice reserves, 24.1 million barrels of 2P reserves. As of 12/31/21, which is the last yearly reserves before their announcement in the end of 2022 that they're buying it. The crucial piece here in this acquisition is that although if you look at the second line on the slide, the second bullet point, although the acquisition was announced in December of 2022 and closed a few months later in March, it was actually effective from September 1st, 2022, which means that three and a half months or so prior to the deal signing, the company was becoming theirs. 7 months prior to deal closing, the company would be Valeura's. So at the effective date of September 1, 2022, which is when the transfer was retroactively happening, at that point, the Mubadala Energy's assets were balanced in terms of assets and liabilities. The cash on hand, if you take away the accrued liabilities and the income taxes payable, netted to zero. But this is a profitable field. So at the time they actually closed on the field, there were 7 months of highly profitable production that all accrued to Valeura's benefit. So how much did they pay? So they paid $10.4 million purchase price for these 3 fields, which in exchange for the $10.4 million, they received at closing net cash of $105 million, besides getting the highly profitable assets. So I give you $10.4 million, you give me $105 million. I don't know where I could sign up for such a great deal. If anybody who wants to do such a deal with me, I'm willing. They got these fields that are producing $15 million a month. They got 7 months of production to their benefit, $105 million in net cash in exchange for $10.5 million. It's just simply no words to describe. I'm sure a lot of you people are going to be scratching your heads like, how in the world did such a deal get made? And I was definitely wondering the same thing. And the answer is that Mubadala Energy, for ESG reasons, was seeking to divest itself from oil and concentrate on gas and renewables, cleaner energy. And it's really breathtaking. it's what the world's coming to, that even Abu Dhabi, that the Arab oil sheiks are selling their oil assets because of ESG for less than cash. I'm not sure what to say about that, but if they're willing, I'm willing. There was a contingent part of the payment. They would pay up to $50 million contingent payment if the oil price would spike above $100. In that case, if it would spike above $100, we'd be making much, much more than $15 million a month. So they would be much more than making the $50 million if it would spike to above 100 in 2022, 2023, or 2024. We're now in 2025. In neither of those years, none of those years did oil average above 100. So the contingency has expired without triggering. So in the end, they only paid $10.5 million for these assets. Absolutely incredible. No words to describe deal. So this is on paper what the deal was supposed to look like. How did it end up working out? So first of all, here's the fields. We wrote down the reserves, the oil flow per field, what the apex is. You see Nangyao has a really low apex of $12 up to about $30 for Jasmine. Overall about $22.50. And then what the fiscal terms are on these fields. So the Thai government has a few different systems of how they deal with producing oil and gas assets. Jasmine is from their first set of rules, the Thai 1 rules. Nangyao and Manora are from their third set of rules, Thai 3, depending on when the field was brought to production, what regime was in place at the time, and that's the regime that you're under for the life of the asset. So Thai 1 is pretty basic, simple rules. You have a 12.5% royalty, which is taxable, creditable, not just deductible, but a credit for income tax. No SRB, which we'll get to in a moment, and 50% income tax. In Jasmine's case, there's also a commercial royalty on the field that they owe to commercial parties of about 8%. In various slides of the company, they mention that the royalty is a 4.5% royalty. I'm not sure how exactly to square that, because when I see the financials, they do seem to be paying a historical about 7 to 8% commercial royalty. So I wrote down here 8%. So you have 8% commercial royalty, or 12.5% royalty to the Thai government, and 50% income tax. Now, since that royalty to the government is creditable for income tax purposes, you can really ignore it, because as long as the field is making enough, is making it more than 25% of the gross revenues of the field is coming to pre-tax income, you could have a 12.5% tax rate anyways. And the field is definitely above that. So that royalty is not really making a difference in Jasmine's case, at least. Nangyao and Manora are on Thai 3 terms. It has a sliding royalty rate of between 5 and 15%, depending on how much the field is producing. For both Nangyao and Manora, it's about an 8% royalty rate. And then there's the SRB. SRB is a special Thai royalty tax, stands for special remuneratory benefit. Basically, it's a windfall petroleum tax on supernormal operating profit. But not if you buy oil fields for very cheap, you don't have to pay extra taxes on that. It's the operating economics of the oil field are supernormal. So if oil price is very high, or if you have very low cost wells, so that the amount of money that was put into the field through CapEx and OpEx to produce development, exploration wells, all that's included. The amount of money that was put in to produce the revenue you're getting is very low compared to the revenue. So you have very profitable fields. So then they stick on an added tax, somewhere between 0 to 75%. The company said, Valeura said that when they were closing, that Nangyao had about a 20% SRB and Manora has about 8% SRB. I think things have slightly changed since then. As far as I can see, Manora has just about no SRB today. And Nangyao has become more profitable over time with some new development there. I think now it's somewhere in the 25-30% range of SRB. And then and out of that, there's a 50% income tax. So you're paying a royalty on the gross revenue. Then you have your capex to your OpEx to pay for, your capex. All that is you take deductions for the royalties, the OpEx, full capex recovery with an uplift, and then if it's a highly profitable field, which is based on a complex formula depending on the revenue per meter drilled through the life of the field, then you have the SRB, and then you have after that the income tax, which of course also deducts for, not a credit this time, but it deducts for the royalties, the SRB payments, capex payments, depreciation payments, G&A, as you'd expect in a regular income tax. And that's an income tax of 50%. So that's the terms behind these fields. How did these work out for Valeura? So it worked out extremely well. So the key to understand, and really this is the crux of the whole investment thesis here, is if just take a step back, we said here there's 24.1 million reserves, 24.1 million barrels, and they're producing 21,200 barrels a day. So if you do the math, that means they're going to run out of reserves in a little more than 3 years. So that makes it not so interesting anymore. You're getting the money, but you're getting the money over 3 years, and then at the end of the 3 years, you're gonna have to pay money to close the field down, shut off the wells, all your decommissioning obligations to make sure there's no leaks, and there won't be any leaks forever. And it's still a good deal for the price they paid, but it's not so great when it's basically a cigar butt, end of the cigar butt, gasping, dying breath, that you're going to run out of oil in 3 years. But the crux of the investment thesis is to understand that that's not really true. Gulf of Thailand has unique geology in this matter, which is that the best way to describe it is multiple stacked reservoirs. They have oil reservoirs, and underneath that is, you drill a bit more, you have another oil reservoir, you drill a bit more, another oil reservoir, you go a little bit to the right, you got more. They're not connected to each other. They're multiple stacked reservoirs right near each other, on top of each other. This is throughout the Gulf of Thailand. Reserves replacement is the name of the game. The reserves that you see reported on the official 2P reserves, as you drill and as you get oil, you find more reserves, and you find more reserves, and you find more reserves. And this is the way that the Gulf of Thailand geology is built. This is the way, this is not just common, this is basically across the board, this is what happens. For example, when they were negotiating, as I said, this deal was actually, even though it was finally announced December 2022, it was actually being negotiated before the first acquisition. It was being negotiated back in 2021. Back when they were starting these negotiations, plans were that Valeura would cease production and be abandoned in 2022. Did that happen? No. 1 year later, at the announcement in December 2022, abandonment was being pushed out 3 years to 2025. And on top of that, another 2 wells were added to the business plan, both of which have been successful, and there have been more wells since then, and they've been pushed out even further. Now the end of life of the field has been pushed out to 2027. Prediction, spoiler alert, it's going to be pushed out further, past 2027. Time and again, this is what's happened with the oil fields in the Gulf of Thailand. Another example, 2022. They didn't own these oil fields yet. They were still in Mubadala's ownership, who wasn't putting that much money in to developing the fields because they were actually looking to divest them. So they started the year with 24.1 million barrels of 2P reserves, proven and probable. They had a full year's production of 7.6 million barrels. And they ended 2022 with 2P reserves of 23 million barrels. So despite having produced close to a little less than a third of the reserves that they had at the beginning of the year, the end of the year was almost the same amount of reserves. That's a textbook example of reserves replacements in action. So this is not oil, these are not oil fields that are in 3 years going to be finished. They're in 3 years, they'll say it's going to be finished in another 3 years. 3 years after that, it'll be another 3 years. It's constantly As you drill, take out oil, you find more oil right underneath it. You drill, take out oil, more oil right underneath it, next to it. This is constantly happening throughout these fields. 2023, now this is under Valeura's ownership. Each field replaced reserves at a faster rate than production depleted reserves, and each field pushed off the retirement date. We have here Nangao, Jasmine, Valeura. Nangao produced 2.7 million barrels over 2023. How much reserves were added? 3.9. Substantially more than 2.7. Jasmine produced 3.4. How much were added to reserves? 3.8. Valeura produced 1.2. How much was added? 1.6. Overall, they produced 7.3 million barrels, but added to reserves 9.3. So they ended up the end of 2023 with more reserves than they started. And this is a constant theme throughout these fields, in the entire life of these fields and the entire Gulf of Thailand as a whole. We're going to touch on this again later. This is the key to understanding the profitability and the long-livedness of these fields. Abandonment on all the fields was pushed out. Nangao was pushed out from mid-27 to the end of 28. Jasmine from mid-26 to the end of 28. And Valeura from the end of 2025, beginning of 2026, was pushed out to mid-2027. The reserve life index, which is how many years would it take you to pump out reserves at the present rate that you're going, moved from 3.5 years to 4.5 years, with an average reserve replacement of 127%. This is what they bought from Mubadala. If you count in Wasana, which you got from Chris Energy, the average reserve replacement across the portfolio was 219%. So they're replacing reserves faster than they're actually producing. Operations. So this is basically just going over what they've done in their stewardship of the assets, the execution that they did. They've executed very well. Did what they said they're going to do, optimized further. They tell you they're going to do things in a certain order, and then they see they could do it better by doing a different order. They optimize and constantly looking for the best way of doing things. 2022 was basically all about the acquisitions, getting Wasana back online, recertifying the Wasana MOPU, leasing an FSO for Wasana. 2023, there was some financial, sold some about 4 million shares to support the Wasana restart before this is before the closing of Mubadala, so didn't have access to that cash yet. There was a Thai SPV structure. They bought the assets from Chris Energy and from Mubadala. They bought it through a SPV, a special purpose vehicle, that was 85% owned by Valeura and 15% owned by various other parties. People with on the ground knowledge of Thailand. It was easier to get the deal done together in partnership with these people. And in 2023, they collapsed that structure. They gave 9.5 million shares of Valeura in exchange for collapsing the structure. Now, all these fields are 100% being owned by Valeura shareholders. That 9.5 million shares at the price at the time that they did this was about paying about another $18 million to get the last 12.5% of the company as a whole. 2022, they sold the Rastican field, which we spoke about, for the ongoing $5 million royalty per year. They relocated the executive management from Calgary to Southeast Asia. Did very successful infill wells, appraisal wells across the portfolio, and they brought their CapEx and their OpEx were both substantially under guidance. Always good to see. 2024, this past year. So Nang Yao, they had an A and a B platform. They've now developed Nang Yao C. This was already under discussion before Valeura bought it, and they brought it to conclusion. A new MOPU, which was built and mobilized to Nang Yao C. It's connected to existing Nang Yao infrastructure via pipeline. They drilled, the plan was to drill 6 producer wells. They actually drilled 7. a seventh as a backup to always have just in case. They did all this drilling faster and 25% below budget, which actually freed the drill rig for other locations. So basically, you're leasing the drill rig for the whole year. So the better you're able to utilize that drill, the more you could do. So they ended up being able to use that drill they had for additional Nangyao A infill drilling, and they were able to accelerate some of the Menorah drilling that was supposed to be in 2025. They were able to do that at the end of 2024 due to having executed very well on the Nangyao C drilling schedule. Further, across 2024, across the portfolio, they've done infill appraisal drilling. They again expect to see reserve replacement in excess of 100% of production. That should come out sometime in the next few months, the next update on the reserves, and we expect to see that as well. They've done exploration in Nangyao D and northeastern Wassana, which is what we spoke about before. It's again on the bottom of this slide, the FEED analysis for potential redevelopment of Wassana field. A final investment decision on that should also again be upcoming within the next few months. They actually managed to get a better price for the Wassana crude oil. It was originally selling for $6 to $7 discounted from Brent price, and they brought it up to actually gaining a premium over Brent, which I was talking to the company how they actually did that. You know, oil is oil. You can't exactly brand your oil, but the Wassana crude is medium sweet oil, not light sweet and not heavy and acidic, but medium sweet. So as a refining oil, it was worth a little less. So they were getting a discount to Brent, but they developed a new market by selling it as a bunker oil to be blended with oils for marine fuel. And for that, it was actually quite suited. And they were able now to sell it for a premium over Brent by selling it to the right market compared to where it was being sold before. We have here on bold really important piece of information here. If you remember, at the end of acquisition one, we said that they paid $14.3 million and they got Wassana oil field, which is making $12 million a year pre-capex, plus the royalty that they're getting from Rasukan. But there was also, we said, heavy tax advantages. So that's what they did here is they reorganized the corporate structure. They brought Wassana, Nangyao, and Menorah together under one umbrella. Those are all Thai 3 assets. Jasmine is a Thai 1 asset. It can't be brought under the same corporate umbrella for that reason. But all the Thai 3 assets were brought together under one corporate umbrella. And now the $397 million as of September 30th, 2024, the $397 million tax shield that Wassana had now covers Wassana, Nangyao, and Menorah, all of which are going to be tax-free until the tax shield is used up. You still have to pay royalty, you still have to pay SRB, but the 50% tax rate on the net no longer applies to, it never applied to Wassana because they had the tax shield, but now it doesn't apply to Nangyao and Menorah, which are Nangyao is the real one, it's a much bigger field and much more profitable than Wassana, and it's getting the benefits in the tax shield. It's not just a matter of accelerating the tax shield, which is also, of course, quite lucrative, but Wassana as is would not necessarily make enough money to cover and actually take advantage of that whole $397 million tax shield. We don't know how many, I mean, it could be they eventually would, given the reserve replacement and this new development, Wassana North, it could very well be that Wassana would eventually. But on paper, Wassana in present reserves only has able to take advantage of about 70 million of those of that tax shield. And now, by being able to apply across Nangyao and Menorah, you're able to use the entire tax shield. In fact, I would expect that in their next financials for year-end 2024, we should see them recognizing that tax shield back on the books and seeing a much, just an extraordinary gain, one-time extraordinary gain, just from recognizing the tax shield on the books. Okay, so this is basically where they're coming from. They did these great acquisitions. They're working out great. They're working out exactly as predicted, and reserve replacement, and it's going to continue. It's had reserve replacement, continuing to have reserves replacement. All signs point that it will continue to have reserves replacement for the foreseeing future. I think it's very likely that we'll be sitting here in 2050 and be talking about how these fields are continuing to produce with reserves replacement. Let's talk about our forecast for the future and then valuation and risks. So this page here shows Valeura's guidance for 2023 and the actual, 2024 and the actual. And basically, I've just put this on the slide, this up here just to show you how their guidance is reliable. They've basically always made within or better than guidance. You see in 2023, they predicted CapEx of 180 to 200 million. CapEx came in at 138, below guidance, significantly below guidance. That was due that they were originally planning to use 2 drill rigs for different parts of the company, but with the synergies of combining Chris Energy with the Valeura assets, they were able to collapse it into 1 drill rig for the whole year, so substantially cheaper. OpEx was guided for 220 to 240 million. They came in below that as well at 203 million. So they do very well with the guidance. They guided to receive approximately equivalent to Brent per barrel, and they actually got a little better than that. 2024, similar. They did towards the low end of their guidance. Very decent execution. So that brings us to 2025 guidance. They're guiding production with a midpoint of 24,000 barrels a day. Again, they're guiding for approximately equivalent to Brent, even though they're still getting more than Brent for there, but they want to guide conservatively. OpEx of 215 to 245 million, which comes out to about $26 a barrel. And then CapEx of 125 to 150 million, which is a mix of maintenance CapEx as well as growth CapEx for Nangao D, rat tree exploration, 11 million, different parts of the portfolio. And this is not counting any CapEx for Wassana North. That's still waiting for the final investment decision. If they decide to go ahead with that, they're going to update guidance, which what CapEx would be needed, to develop that part of Wassana. Okay, so here I run the numbers. I'm running with a price point of $70 a barrel of Brent. Right now, Brent is about $80. So this is a very conservative look at the things, imagining that that oil will come down quite a bit, $7 a barrel. What would they be making at their production levels? 24,000 barrels a day, 8.8 million barrels produced for the year. So they would be making 613 million revenue. Off that, they would be paying royalties. I'm not accounting for the Jasmine royalties here of the 12% to the Thai, because that anyways is credited to tax. So I'm just including that in the tax. So just the 8% commercial royalty that Jasmine has, and the approximately 8% royalty of Manora and Nangao. So that's about a little bit under $50 million in royalties to the Thai government and the commercial parties. And then there's OpEx of about 230 million, gets us to an operating netback of 334 million and change. G&A of about 25 million. It's a little bit more than they've been having the past few years, just being conservative here again. Pre-tax cash flow from operations of 309 million. The SRB, I am accounting this for about 28% rate of Nangao's production. This is probably a little bit conservative on my part. They're probably gonna have a slightly lower SRB rate, but better safe than sorry. And then the 50% income tax rate after deducting for the SRB payments, etc. You get the cash flow from operations of 212 million, maintenance CapEx of about 110 million, which gets us to free cash flow of just under $102 million a year. This is at a $70 oil price. At the actual oil price that we're experiencing now of $80 a barrel, then you'd be looking at 158 million free cash flow. And if, on the other hand, oil would drop 25% from $80 to $60 a barrel, you'd still be making quite a respectable $45 million a year, considering the price that you're paying for the company of an enterprise value of about 360 million, $45 million a year is really, really not bad at all. And that's if the oil price would drop 25% and everything else would stay the same. Then we have on the right side, we have growth capex, exploration, what the net cash flow after that is, operating netback per barrel, cash flow operating per barrel. This is very profitable fields. Even certainly at the $80 oil price, even at the $70 oil price, and truthfully, even at $60 oil price, this is quite decently producing oil fields. Future. So the future, we can expect years and years of reserve replacement going forward. Like these have had in the past. We have the tax shield going forward for all fields, besides Jasmine. We have the stack buyback instituted in November, up to 7% of shares. They've already purchased and canceled 348,000 shares since they announced in the beginning of November, in Q4. So just under 2 months, they've purchased and canceled 348,000 shares. They're saving their money. They're still looking to make more acquisitions. They see that the Thailand region and the greater region near Thailand are ripe for consolidation at their size, for their size company. But they've been so profitable that they said that they see that they have money to be able to do both the acquisitions that they would be hoping to do, plus buying back their own stock, which is incredibly undervalued. As we've spoken, as management absolutely been pounding the table about how undervalued they are, and it made sense to buy back stock, especially because they can still acquire more to begin with. They have organic growth from within their portfolio. We have Wasan North with the final investment decision upcoming, potentially up to 20 million plus of 2P reserves. They have appraisal ongoing in Nang Yao D. Ratri is a potential development within the Jasmine license, which has exploration plans for 2025. That could also be a very big deal. A little bit more speculative, but can potentially be a very big deal. That's just on the organic growth side of things. You look at inorganic growth, they are very much on the hunt for more acquisitions. Right now, they're producing about 25,000 barrels a day, and they have repeatedly said that their goal is within the next few years to reach 100,000 barrels a day through acquisition, and they are really well situated to acquire more assets in the region. They're an experienced operator. They have good relations with the Thai government, a very solid balance sheet. Majors, the Chevrons of the world are exiting the area due to materiality for their size. There are few competitors of similar scale to Valeura that can actually buy the sort of acquisition, game-changing acquisitions that they're looking for. And the few potential competitors that they do have for these bids, be it Hibiscus or Jadestone, are suffering from either operational difficulties or too much debt or both, and are not really in position to make bids on the assets that they're looking for. They're seeking acquisitions, surely in the Gulf of Thailand, as well as the border region, Indonesia, Malaysia, Vietnam, maybe even as far out as Australia for the right asset, oil or gas. They're experiencing both. The upper level management team, by the way, Sean Guest, has extensive experience in Southeast Asia from before his Valeura days, so he really knows what he's doing in this region. They obviously have a lot of gas experience from Turkey and from before that as well. They actually would prefer to balance out the portfolio a bit with gas because of both the balance out the portfolio and because gas in that region is generally sold on long-term contracts. So a gas deal can potentially be a stable source of income. But really, they're looking for whatever is good value. Again, usually I'm not big into companies that are looking to acquire because acquisitions tend to be value destructive. But I think we should make the benefit of the doubt for this management team, which has really shown stellar capital acquisition traits. They were willing to wait patiently until they got just the right asset for that $40 million, and they did amazing deals with that. They could have said, listen, we have the Roscoe oil field, let's pour money into it, let's borrow money, let's sell shares and, develop that Roscoe oil field themselves. But no, they had the discipline to say, no, we have what we have on our plate. the Raskin oil field is a little bit too much money for what we're looking for. They farmed it out, sold it to a third party, kept the royalty on that. So I really think that they've shown their ability to and even since they closed on Valeura in mid-2023, they've been talking about acquisitions. They're still waiting to get that perfect acquisition. They're not looking to overpay. They're looking to get, I don't know if they can get as good as they got on these two deals. They're looking to get great acquisitions, not just spend the money for the sake of spending the money. So I'm willing to cut them some slack, and I'm looking forward to see what the next acquisition potentially is. And we still have that free option on the Turkey gas play. They're not looking to develop it themselves. They're looking to find a partner to spend money towards developing it. Maybe it'll happen, maybe it won't. As far as I'm concerned, that's a free option. Even without that, the company is tremendously undervalued. Which takes us to valuation. The valuation is really pretty simple. As of yesterday's share price, January 13th, 2025, the share price was $7.93 CAD, Canadian dollars. Total shares outstanding, a little bit above 110.5 million, which brings us to a market cap of 877 million Canadian dollars. US dollars, which is what most of the figures throughout this presentation have been in. So the market cap is 610 million US dollars. Cash as of the end of the year was 259 million. With zero debt, the enterprise value of 351 million, over a free cash flow of 102 to 158 million, as we just walked through before, which gives us an EV over free cash flow ratio of 2.2 to 3.4 times. This doesn't take into account the fact that they will have some income taxes that are payable plus accrued liabilities. But then again, they also have oil inventory that's not being sold at the end of the year, and various other current assets, receivables, and things like that. So those probably are close to balancing out, if not actually balancing out. In a few weeks, we'll get the full data for the fourth quarter, and we'll get the exact net working capital number. But I don't think it's materially change what we're seeing on this slide. I suspect the net working capital is somewhere in that $200 to $250 million range, and we're looking at pretty much the same numbers. This slide is, I basically took the slide from one of Valeura's presentations, where they compare Valeura in various ways to the peers. The top is comparing Valeura's enterprise value over the amount of barrels they're producing a day. And they're about, this slide is from December 3rd, so it's using a 621 Canadian share price instead of we're using 793. So the numbers are a little bit outdated, but basically they're highly undervalued on that enterprise value over working interest production ratio. If you compare by EBITDA, they're a little bit more than half of the median of the peers. And if you look at a cash flow basis, they're even more undervalued. So they show on the right that what the number would be if you use their NPV 10 based on the 2P reserves would come out to 763. We'll talk about that a little bit more on the next slide. And then what would be somewhere in the $14 range if they were trading similar to peers. On this slide, what we have here is, again, the top half of the slide is again taken from Valeura company slides. The reserves, besides the number of barrels that they have, it also shows the net present value, if you discount at a 10% discount rate, the NPV 10, the net present value discounted back at 10% a year, take into account all CapEx, APEX that is needed to, all CapEx and APEX that is needed to get the oil out of the ground and sold. The end of December 2022, the net present value of their reserves was across their 4 oil fields is about $261 million. With the 219% reserve replacement, and the reserves went up a lot by the end of 2023, the net present value was about 429 million. So if you take that 429 million and you add in 100 million for the corporate tax restructuring, which is, I'm figuring about 100 million of that is new, that wouldn't be covered by Wasana alone. And you have to discount back that number as well. So I came to $100 million. I think about $200 million new. I'm using 100 million to be conservative here. 429. Let me say that clear. There's a 397 million tax shield that's worth just under $200 million at a 50% tax rate. Some of that would have been used by Wasana anyways, and was already included in the NPV 10 that was produced by the external reserves auditor in the end of 2023. But about 150 million of that value was not included because Wasana wasn't going to produce that much. So there's about 150 million that we should add from the corporate tax restructuring. I'm only counting as 100 million due to discounting it back in time. Then you add in $259 million of cash as of end of the year. That brings us to a total value of the whole company of 768 million, which would be equivalent to 998 Canadian, which is about 26% higher than the present price of 793. In reality, we have to stress that this arithmetic dramatically undersells the situation, because that's imagining that the entire value of the company is in their present reserves. But given the steady reserve replacement, we're going to get all this 429 million of reserves, and we'll still have 429 million reserves, if not more, due to reserve replacement. So the value of the company really is, this is sharply underselling the value of the company by using the NPV 10 on 2P reserves. Risks. So always have to talk about risks. The three major risks are the price of oil, the life of the assets, and decommissioning obligations. Let's take them one at a time. Price of oil. Right now, they're unhedged for the price of oil. They're willing to do hedges at the right price. There was a point in time they almost made a small hedge, but then the price on the hedges shot up again. So they're unhedged, which means they benefit from the upside when oil goes up. They lose from the downside if oil drops. But as we already showed, even if oil drops to $60 a barrel, they're still doing quite well and quite profitably. Not as profitably, of course, as if oil is higher, but they're not in any trouble whatsoever. They're highly profitable, even at significantly lower prices of oil. Their break even is in the mid 40s between the capex, the apex of about $26 a barrel across the portfolio. Capex is about $18 a barrel or so, maybe a little less. So that would be a break even in the mid 40s. They have a solid balance sheet, no debt. They would not be in distress if the price of oil drops. They're in a very good position. In fact, they could probably take advantage of turmoil created by volatile oil price by acquiring more assets on the cheap. Although I'm sure that if that actually did happen, the stock price would suffer together with the rest of the industry, but they would probably come out ahead in the long term. Asset lives. How long are these assets going to last? So we've spoken about this again and again. Reserves replacement is the name of the game. And on these slides, I want to focus a little bit more on that. On the upper left here, you have Nangao. When it was brought online in 2014 for the first time, it was expected to make 3 million barrels of reserves. That's it, 3 million barrels of 2P reserves. Since then, it's already produced 26 million barrels. So almost 9 times as much. This is through the end of 2023. 2024, we didn't get the reserves yet. So through the end of 2023, it already produced 9 times as much as the original amount of reserves they were supposed to have. But it's been replaced and more than replaced. So it's been replaced with $37 million of 37 million barrels of reserve replacements. So they actually ended 2023 with far more reserves than they had originally had to begin with, despite having produced that level of reserves again and again and again. On the bottom left, you have Jasmine, which is actually even more mature in its point of its life cycle compared to Nangao. Nangao is still a growth asset with Nangao C, Nangao Jasmine, less so, although they are exploring Rattree. But Jasmine is a more mature asset. It came online in 2005 with 7 million 2P reserves of barrels, 7 million barrels of 2P reserves. They produced through the end of 2023. That's close to 15 times as much as the original reserves. 92 million they produced, and they added 95 million in reserves replacement. And so they actually ended up at the end of 2023 more than they had to begin with in 2005, despite close to 2 decades of pumping oil from Jasmine. On the right, we have across Mubadala's, across Valeura's 4 oil fields, Wasana, Jasmine, Nangao, and Menorah. We're combining all of them in this chart on the right, and using historical, going further back from before Valeura's involvement in these assets. We have the reserves. This is a chart that's based on the Thai regulators' public disclosures of each field's reserves. So those are not using 2P reserves, it's using 1P reserves. So just proven, not counting probable. And you see there at the end of 2018 that these fields combined had about 20 million reserves. They produced in 2019 and then added more in 2019. The production is the red bars, and it added reserves with the green bar to end up a little higher than 25 at the end of 2019. Then 2020, it produced, and then it actually dropped reserves a little bit because of reserves depends also on the price of oil. So the lower price of oil at the end of 2020 caused the reserves to come down a little bit. 2021, they produced more, and they replaced the reserves again. 2022, the same story. So from 2018 to 2022, 4 years later, they did a whole bunch of production across the fields, and still they ended up with slightly more reserves at the end of 2022 than they had at the end of 2018. And then the next box that's circled in blue there is under Valeura's ownership, the 2023 reserves. Again, across the 4 fields, they replaced far more than produced, and they ended up now with 30 million barrels of 1P reserves. Again, this is to be comparable to the rest of the chart, which is 1P reserves. And basically, this is the reason behind all this is in that gray box on the upper right is the Gulf of Thailand. That's the way it works in hydrocarbons in the Gulf of Thailand. It's multiple stacked reservoirs, numerous fault blocks, year-on-year growth through multiple targets in every well. Reserves and total production typically greatly exceed initial view and supports continued cash flow and abandonment deferral. In fact, stepping out in the Gulf of Thailand as a whole, stepping out and drilling a new well next to your old well is basically 95% success rate. Is historically has been shown across the Gulf of Thailand. And here what we have really this slide is showing the entirety of the Gulf of Thailand, not Valeura assets in specific. You have at the end of 2020, again, this is based on Thai regulated public disclosures. On the website, you can download all this information yourself and work out the same numbers. The end of 2020, the entire Gulf of Thailand had 1P reserves of 795 million. This is oil and gas, I believe. Then they and an asset life left of 3.2 years. They produced, replaced, produced, replaced, produced, replaced, and they end 2023 with 929 million barrels of oil equivalent and 4.9 years of life. So 3 years after only having 3 years of life, they actually now have almost 5 years of life. This is the story of the Gulf of Thailand. This is the story of the Valeura assets continuously replacing reserves, replacing reserves, replacing reserves. So I believe this is the one key aspect that the market's not getting about Valeura. They look at Valeura, they see, the reserves show short life. This is an end-of-life asset, and then we're gonna have a decommissioning obligation. Not interested. And this is the key mistake they're making, that's not the way the Gulf of Thailand works. And it's going to constantly be replacing the reserves again and again. And that gets us decommissioning obligations. Yes, there are decommissioning obligations. At the end, sometime in the far future, they're going to have to spend money to close off the wells for good and make sure that the environment is kept safe with fully plugged up wells, etc. The main strategy that Valeura has to deal with this is to keep on pushing off decommissioning into the far off future. And the value of the potential cost of decommissioning, the further it goes off into the future, the less of a worry it is to us today, given the discounting of the future far off liability. They also expect to lower the ARO, the asset retirement obligations. They expect to lower the ARO costs through modern technology and increased scale of cooperation across the Gulf of Thailand. There's been a lot of innovation in the decommissioning of wells in the Gulf of Thailand to bring down the cost over there, and they've already brought down their estimates for ARO by about 30%. In June 2023, the estimate's $494 million, and in the last reported figure at the end of third quarter of 2024, the number's only 138 million. So they have already seen success in bringing down the expected costs of retiring, decommissioning the wells, and they expect to bring down the cost further, bring down the cost, and push off the cost further and further into the future to be less and less relevant to today's discounted price. So that's what we have on Valeura. I hope you enjoy this, and I hope you realize and see why I consider Valeura the cheapest and best oil company on the planet.
Well, Mordechai, very, very interesting thesis. Thank you so much for this presentation. We
I hope it didn't take too long.
What's that?
I hope it didn't take too long. It was a little longer than I expected.
Well, it's a very in-depth case. I basically have no questions given that you were so thorough in explaining this thesis here. Yeah,
If anybody has any questions, they should be free to reach out to me. On the first slide is my email address, myavne@focuscapitaladvisors.com. I'd love to hear any comments, criticism, agreement, or questions. Send them in my direction. The company is also very easy to reach out to. You could talk to Robin Martin, the head of IR, is very knowledgeable about that company. You could talk to the CEO. Very easy people to deal with.
Great. Well, let's leave it there then. I would definitely encourage our members to feel free to reach out. We are also always happy to facilitate an introduction. Thank you so much, Mordechai, for bringing such an interesting idea to the MOI global community. We really appreciate it.
Okay, great. Thank you, John. Thank you for having me.
It's a pleasure. Goodbye for now.